podcast. I'm your host, David.
And I'm your co-host, also David, David's dad.
Welcome back to another episode of Bull in the Cup. We have a very special guest today, Andrew Horowitz. He is the host of the Disciplined Investor podcast. He is an author of multiple books, including the Disciplined Investor, where he is president of Horowitz and Company, where he has helped manage money for many decades. I'm not sure how he has free time, but we're thankful for having him with us today. Thank you, Andrew.
Thanks, Dave. Appreciate it. How are you?
I'm good, thank you. Let's get started with the question. What first attracted you into investing?
Oh, that's a good question. It happened in two parts. So I think when I was young, I was really interested in numbers and math, right? I was just better at that. I was better at math than I was at sports. I was better at numbers than I was at English. Definitely better at equations than I was at Spanish. That was no good back in the day. Matter of fact, a quick story. I walked into my 10th grade Spanish class after 3 years of Spanish, and professor was talking in Spanish. I'm like, I have no idea what you're saying. I like literally, everybody on the class seemed to know. I'm like, you know what? This may not be for me. So, but then from there, I always had a passion for my dad was in related into the related financial business. So there was always kind of this whole thing going on with up in New York when I lived there, the news, it was 10:10 wins news at 20 after the hour and 10 to the hour. The market report would come on and we'd always listen to that in the household. And it was kind of a really fascinating side of things. And even as early as when I was 13 with my bar mitzvah, I kind of, took some money and we invested it, and I learned a lot about things that far back. And then fast forward, the second part of it was, I thought for a little while there I wanted to be a chef, but then kind of not, and be in the restaurant business and then not. And then my dad said to me when I was, 20-ish, why don't you try out the financials and insurance business? And I'm like, ugh, that sounds awful. It sounds so boring. It's just, I've been making a good living at it for years. Why don't you go try it? So I tried it. Long story short, it turned into something that I was very passionate about, changed the way I did things over time, but always in the background was investing, stocks, and markets.
Well, I think David's going to relate to you on the Spanish front. He's in the middle of a Spanish class as he's starting high school now, and so he may relate to you and say, "Okay, this is not for me. I'm leaning more into the financial sector." But go ahead, Dave. Let's get more into Andrew's background.
You've been managing money since the late 1980s. What lessons from this era can still help apply today?
First of all, I think one of the lessons is don't get too ahead of yourself. Don't think you're so great, and make sure that you're humble. And everything that you do, the market's a lot smarter. And the fact is that I can tell you times going back to the 90s, clearly 2000s, that, you thought you knew what you were doing, but then all of a sudden things changed. And the market is a great, a great leveler of people in terms of the awareness of what is true and what's not. Market is truth. That is the fact. The numbers are the truth. That is the fact. And you could think that you're right the whole time, but your portfolio doesn't recognize that. And that means that you're not right, right? So if there's 100 people in a room and you're the only one that thinks you're right, just to break it to you, Dave Jr., you're wrong, right? So the humility of understanding that there's a much bigger picture than what I believe to be true, which by the way, what I believe may be true, and it may go along with whatever's happening, because if you've ever heard the market's got it wrong, the markets don't get it wrong. That's what happened. The stock was down 15%. That's what happened. You have to understand and have that belief that what is happening around you is reality, even though we don't want to maybe believe something. So I'll summarize one other point for you here. When you look at things like, I think this president's coming in, so it's going to be good for the markets. And no matter what happens, I believe that. When it's actually maybe bad for markets, that wasn't the truth. The truth when it comes to markets and investing is the outcome. So the belief that I am not smarter than the markets, I can just try to understand what's happening, infer, and then capitalize on it. That's what kind of hasn't changed over that period.
Well, that's such good advice, and it crosses over with other industries as well. If you ever are dealing with somebody who claims to be the smartest guy in the room, they're usually not, and that's the problem. And so, your advice of being humble and being able to say, "Look, I'm not right all the time. Let's see what the market says, and the market is the truth." That's such great advice. I love it.
What concerns you most about today's market?
Shrugging it off. The idea that there's bad news and market shrug it off, or there's a war, or the earnings are bad and market shrug it off. And the constant news headline that market shrug it off, there's going to be a point that the shoulders get really tired and there's no more shrugging available. And I'm not sure what that is, but there's something brewing underneath the idea that trying to keep this relatively simple, that we can keep on keeping these markets up relatively with all this stuff going on around it and certain stocks leading the market. I think there's a bit of what we call complacency in the markets. The VIX, the fear factor, the fear gauge, is it what's 16? That's kind of low, without getting into all the nitty gritty of all this, but it's low, which means that people are just thinking that nothing matters. I'm going to keep on putting money in it. And when that happens, again, markets are always right. But when that happens, when we have a situation where people just are careless and ambivalent and complacent, that sometimes will lead to bad outcomes over time.
Well, that's really interesting you say that. We did a couple episodes last season, last year, it should be, particularly like when the tariffs were coming out, and then we saw it later, when the war with Iran picked up. Everything seemed short-term reaction. It was like the tariffs come out, there'd be a short-term blip of a reaction of kind of like, okay, we're worried about, there may be a reaction in the market. Let's have a short dip, and then everything would go back to normal or back up. And it just didn't seem like the market was reacting that much to the lots of negative news going on.
Yeah, there could be also a couple of different things that are reasoning for that. One, you want to go into the weeds on this. You could talk about sovereign wealth funds and countries actually funding things and holding things up, and central banks around the world doing things that are, propping up. That's number one. The second thing could be the theory that, for the last 20 years, we've been trained as investors that when it goes down, it's just going to eventually come back up. And the worse it gets, the more the government's going to come in with quantitative easing, with stimulus and all that. And maybe the third thing could be that there's a realization that if you go back in time and you look back 100 years, those blips in the markets and those real downstrokes are met with longer term uptrends that are part and parcel with the capital markets. And I don't care about that. It becomes a dip worth buying. And that I'm not investing for today or tomorrow. I'm not investing because it's COVID. I'm investing for 25 years from now, and this gives me a good price entry point, so what the hell?
Great advice. Go ahead, Dave. Yeah.
What do you think investors misunderstand most about AI?
Well, that's a good question. What do they misunderstand about AI? That probably AI is trading behind the scenes already, and in fact, there's AI and then there's AI, right? There's AI, as I call it, Andrew intelligence, but there's also artificial intelligence. And the AI that we are talking about, I think, David, what you're talking about is like computers that can think, right? That kind of AI. That's not really here yet, per se. Smart computing has been around for a long time. Algorithmic trading, been around for a long time. The idea that computers can do all sorts of things through automation, that's kind of like AI to a degree. AI, if we stick with that for a second, that's been going on. And the thing that's happening with the markets, relatively keeping the markets up very nicely in an environment where there's all these headwinds, is probably a lot of this lesser smart AI, the beginnings of it, that are holding things up, that are saying, okay, if we pull these stocks up, do it really quickly, these stocks are going down, the markets can still stay levitated because of the way it's structured. The other thing that you're all probably talking about is, AI, like, like war games, right? Like all of a sudden, the computers are going to get a hold of the markets. And what does that mean? Are traders going to be around? Do we even need to trade? What's the point of all this, right? I think there is the potential far out because it has to be adopted too. It has to happen and has to be adopted. So first it has to happen, then people have to say, like, I trust this. That could take years and years and years. It's like a auto driving car, right? We may have it, but people will be like, I'm not letting that thing drive me around. So I think that they're missing here is that it is part and parcel of the markets already. And actually, the second thing I want to say, and I think I talked about this on a podcast recently, is that AI is that they misunderstand that it can be used as a tool to enhance, to help, and to lessen the learning curve of actually understanding what investing is all about.
Yeah, that's interesting. And it kind of dovetails. I wanted to ask some questions about kind of investment philosophy because it certainly does seem like in the tech era, the AI era, things are more volatile. I mean, that's something I'm always talking to David about is, his generation now gets into the market and sees so much movement. They invest in a stock and then, a week later, significantly, I feel like when I grew up, it moved 10 cents and it's like, ooh, it moved 10 cents. That's very exciting.
Well, when listen, in all fairness, when we were growing up also, we focused on one thing at a time, right?
Very true.
David, I'm assuming you could do your homework, watch TV, listen to music, and maybe you ride your bicycle all at the same time, probably, right? Yeah, your dad and I know. We did the homework. We didn't chew gum. We sat straight at the desk. There was no TVs on. There was no food on we just did our homework. That was it. By the way, that's because we couldn't do more. Something There's a genetic mutation that happened along the way that now kids can do multitasking much easier.
That's it. But in the same token, your tagline, disciplined investor, stands out obviously for me. What does that mean for our listener, the concept of being a disciplined investor?
Yeah, that's kind of interesting because when you think about this multi-pronged, one of the things that you have to understand is that you have to play by some set of rules. Can't play by feeling, gut, or somebody else telling you something, right? So David, you're talking with your friends about, all these stocks, and they're like, oh man, but look at the GameStop thing that was going on, or, look at the latest thing that's going on with, there was a Twin V, which is like up 47%, down 30%, or maybe they're all talking about NVIDIA and stuff like that. You got to keep that noise out. The discipline is to understand if you're going to do it through fundamental research, understanding about the company and what they do. Technical is, looking at charts and things like that, or some other methodology that you're using. You stick to it. Now, that doesn't mean go down with a dying ship, right? You stick to it to make sure that you don't deviate from an emotional standpoint or from an outside input standpoint that is trying to sway you. Like, for example, where does that happen? The news, the media. That's an entertainment machine. That is not an information machine for the most part. And that entertainment machine will have people on there trying to, for the heck of it, tell you what they think. They're trying to implant their ideas on you. And at the same time, they're trying to cement it in their own head so they have the belief as well. They're talking about how great IBM was when it was down 25% a couple of days ago. And wait, I thought you said it was great 2 days ago. It is. We actually think the numbers were good, misunderstood. Markets are wrong. Buy the markets. We're buying more. In other words, not picking up the potential cues. That's just one example on IBM. But the idea that the discipline is all about understanding tried and true mechanisms that have worked for 10, 20, 50, 100 years. You take a book like What Works on Wall Street, which was a compendium on quantitative analysis that was written in a way that made us understand something called factor investing, which, really helps us understand a lot about what areas of the markets work during certain times and reasoning why and why they don't. And that kind of tool, understanding other people's mistakes and bringing that to a discipline, whatever that is, whatever you decide to be, is extremely important. One last thing, a gentleman named Jack Schwager, who wrote a series of books called Market Wizards, who's been on my show many times, coming on in a few months. We just scheduled it. He interviews the brightest, and these guys that make, these guys that are good, 20% per year for like 20 years straight. You compound that, you make a lot of money. And what's their secret? What's their wizardry? And it all comes down to, well, a few things. One is disciplines, but it's cutting losses, staying the path, letting your winners run, and not letting things sway you from your thought process.
That's really great advice, and yeah, taking some of the emotion out of it is so key. And the news part really, resonated with us. We just had Kira Shishkin, who has started his own news organization, Inform.now. He's looking to try to give the public actual factual news without the noise. And to your point, a lot of the news becomes entertainment. And if you're investing, you're not looking for entertainment, you're looking for facts and data. And you don't get that on the news anymore.
Right. Or it's a campaign under the guise of news, right? When I say campaign, I don't mean political. I mean a campaign of trying to sway the listener to their beliefs, whatever that is, whether it's investing beliefs, political beliefs, religious beliefs, whatever it is. That's kind of what the news is all about these days.
Yeah, makes sense. Go ahead, Dave.
What's the biggest money mistake young adults make in their 20s?
Probably lack of humility. Back to that again, right? Believing that they're invincible. Let me actually give you the real one. I guess now that I think about this, if I can roll that back for a second. Not saving enough. The power of compounding of interest. Einstein said something like it's the 8th or the 9th wonder of the world, or whatever it is. The idea that your money can compound over time is great, but the more time you have, the better it is. You've probably, Dave, somebody's asked you the question, young David, asked the question that what would you rather have, a penny a day for 30 days doubled, or $1,000 a day, $1,000 a day for 30 days? So at the end of 30 days, $1,000 a day, you get 30,000, right? The penny a day, you start with a penny. So you ever done this exercise, David?
I have
not done the math. Have you done it, David?
Yeah, $5 million after.
Yeah, it's a lot. You go 1 to 2 to 4 to 8 to 16, 32, and you keep going 64, 128, 256, it keeps going. The point is that all of a sudden, somewhere around the 17th or 18th day, it's like, wow, that's real money all of a sudden. And I think the misunderstanding between compound, this is the classic compounding versus simple interest. That's the differential. That compounding effect, if you start adding money to an account, even it doesn't have to be an unbelievable barn burner of an investment account, just a basic investment account at the age of 20, instead of wait till 30, the differential when you're 60 is enormous if you have that money growing for you. So it's not taking it seriously, not saving enough. When you start your job, you max out your 401k, even though it hurts, because the future you is going to look back on the present you and go, man, that guy was smart. Thank you. Versus the guy's like, man, I had all this money through my lifetime, and all of a sudden here I am at 65 years old, and I'm living on Social Security. You don't want to do that. Start out early, start out hard, and do it fast.
Oh, that's some great advice. I don't know if you're nearing towards rapid fire round, David, but I certainly wanted to get one more in on my end. There's a lot of, I think, concerns within the market, whether it's what's going on in the world and how that may impact the market, whether is there some type of AI bubble going on that's similar to the internet bubble of 2000s. But so lots of kind of concerns bubbling out there. But what excites you right now about the market? Is there anything that's really exciting for you?
I think that I know this is going to sound a little boring. Some of the banks look pretty good, and there's definitely some areas of the market that we're seeing that retail is picking up. You have companies like a Shark Ninja that's just been off the hook doing great. Technology is good. Some of the core technology companies, I think, are a little bit stalling right now. The money spend clearly is pretty exciting when it comes to the chips. They have a 3-year wait. Companies like Dell, even though they just got pummeled a few days ago, have been just on a incredible ride higher. Healthcare, people are getting older, and they always get older. People always get older. But what's happening is that the more we have for medicines, the GLP-1s and things like that, what's happening is the longer they're living. And to be honest, what's great about that for the healthcare companies is that the longer they're letting people live, the longer they're living, the longer they're living, the more drugs they need. So there's this built-in selfish nature of them healing people, because they're going to come up with new ailments over time and require drugs and things like that that are going to be constant. There's a lot of things to be negative about with the economy, with the world, with the way trading is going. But there are definitely some areas. I think the banks, the bit of an energy trade looks good. War is not over, in our opinion, and we're going to see the continuation of profitability there. And the CapEx expenditures are going to be good. But when that slows down, all hell's going to break loose.
Hopefully not. Good insight, and it's really good perspective on the health companies. I think I was reading this morning about Merck and FDA approval of cholesterol reducing
Yeah, and a
medicines.
recent Alzheimer's drug. There was a pancreatic cancer drug right now that was going there. Can I give one piece of advice to David Jr.
Yeah.
while it's on my mind, just for a minute, just for a second?
We love it.
Love a stock as long as it loves you. Be prepared for the hard breakup, buddy. You haven't gotten there. You're 14 years old. You'll be there. But the hard breakup, it's easier with a stock, by the way, just to be clear. No, the stock doesn't cry and all sorts of stuff and kick you and tell all your friends what a bad person you are. But the thing is, love a stock as long as it loves you. It doesn't love you. You know what? You don't need to love it anymore. You could just, and then kind of like put it aside, put it back on the list of things to watch, on the watch list. Write things down, by the way. Always write down your thoughts, because what happens, our mind plays tricks on us a lot of times. Write things down. Have a journal. If you could do anything right now, David, is keep a journal of your stocks and why you did what you did. And you'll go back to that and learn from your mistakes, and be honest with yourself. Be honest with, you don't have to show anybody. Be honest with yourself in that journal.
Boy, that's some good advice, Dave. I'm gonna wonder, because I know when you first got into the market, you were early on Palantir, and that generated obviously a lot of excitement because it did so well. And this is not a referendum on Palantir, but I'll be curious with Andrew's advice. Will you be able to at some point break up with Palantir? Is it so, it gave you so much love early on, and you eventually break up when needed? We'll see.
Right. It's giving you shade now, buddy.
All right, David. Any other questions, David? Or do you want to go to rapid fire?
That's all my questions. If you're ready for rapid fire.
Yep. Me? Oh yeah. Let's let it rip.
Okay. The rapid fires is basically just really quick. So to start. Stock you wish you bought earlier.
Apple.
Book every investor should read.
Aside from The Disciplined Investor, that one. Besides that book, there's so many books. I guess Confessions of a Stock Operator, I suppose.
Biggest investing myth.
Biggest investing myth. Biggest investing myth. Can I pass that one? I'll come back to it.
You can absolutely pass. We'll give you another one. Go ahead, Dave.
You didn't give that many the rules that I could do that. I'll think about that.
One habit every investor has. Every successful investor has.
Discipline. And the myth is that stock always goes up. Stocks always go up.
One word to describe everyday market.
Chaotic.
Most important trait for an investor.
Patience.
Those are all of my questions.
All right, I got one more to close this out, because you've been a money manager with your company for a long time. I'm thrilled that you were able to join us. I mean, author, podcast, money management company. A lot of young people investing. When do they need to make the decision of getting a financial advisor to assist them with money management? Like, how does that? A lot of people think you have to wait until they've made it and they've made it big and successful and have a bunch of money, and they go, "What do I do with this money now?" But when is the appropriate time?
So, I mean, there's a threshold for different advisors. So let's start there. So my minimums are, we have accounts where we'll start at 25,000 for people, because the podcast, The Disciplined Investor that we run, a lot of people came at us and wanted to start investing. And we're like, well, my minimum is 500,000. I don't know what to do. So we opened up a new program so people could start with 25,000. But for most people, it's that kind of situation that's going to happen. Like, advisors won't be true advisors, they'll be brokers until you get to a certain thing. But I think it's when you feel that you could no longer handle it yourself. And here's what I mean by that. When we're young, and I don't know if this describes you guys. 'Cause I don't know you guys, but like my parents would cut my hair and stuff, and then I'm like, I don't want them doing it anymore. And maybe I could do it, but then I realized I can't do it. Why can't I do it? Because it's a matter of perspective, right? I can cut. I could use scissors. I can cut my hair. I could do all sorts of great things with that. You could do that too, right? We could use shears. We could use clippers, whatever it is. I could put the number 1, the number 2, but you know what? When it comes around the back of my hair, ain't gonna be so good. I'm gonna be like, oh, messed. I can't. I'm going to go left. I'm going to go right. I don't know which way the mirror. It's a matter of perspective. When you can't have that perspective anymore because maybe you don't understand all the things about the taxation, about capital gains, about wash rules, about all that, maybe that a time is to move to somebody else. Number 1. Number 2. Let's say you're a lawyer, for example. You're a doctor. You're doing something in life. Probably your best earnings are going to come from what you are passionate about and what you're doing every day, 8 to 10 hours per day. The idea, the silly idea of putting in an hour a day and trying, you've seen these commercials on TV, right? All you need is 15 minutes a day to make 20% per week. Ridiculous. The idea of doing that, you know what? You don't do your own EKGs. You go to a doctor for that, right? You don't do your own physicals. You don't do your own haircuts. You go to somebody else for that. Embrace the idea that you go to somebody who's an expert early on to help you. I think that's the best thing you can think about.
Excellent, excellent advice. Nothing else on my end. I want to thank you, Andrew. I mean, the Disciplined Investor, the book, the podcast. Follow him on Twitter, X, online. Just it's been some great advice I've gotten. Listening to you, thrilled to have you on, David. Anything else?
No, that's all. Thank you so much.
All right, guys. David and David, appreciate you guys.
Thank you, my friend.
Thank you.